If your stop losses keep getting hit, you're likely taking low accuracy setups. To fix this, we are going to combine three completely separate trading methodologies: price action, Fibonacci, and smart money concepts, to pinpoint one single highly accurate trade location. The first tool we need is the Fibonacci Retracement. This chart shows an upward price trend with the Fibonacci grid applied. We use this to measure exactly how deep a market pullback really is. A common trap is buying into a minor pullback. If the price drops by barely 30%, it lacks the depth required to sustain a move. This is an invalid setup, and buying here leaves you exposed. Instead, we wait for the price to drop into the golden zone. This is the specific area between the 0.5 and 0.618 Fibonacci levels. A drop into this pocket gives us our baseline requirement for a valid setup. By automatically filtering out shallow dips and restricting your attention exclusively to the golden zone, you immediately eliminate the low probability trades that drain your account. Now we layer our confirmations. First, we need to prove the market is actually trending up. This chart shows the price breaking straight through a previous resistance ceiling. In price action, this is a confirmed break of structure. Once structure breaks, we pull our Fibonacci tool from the swing low to the swing high. We then verify that the resulting pullback lands perfectly inside our 0.5 to 0.618 golden zone. Finally, we look inside that exact same pocket for smart money concepts. We need to find a fair value gap resting directly on top of an order block, completely contained within the golden zone. When a break of structure gives us direction, a golden zone gives us depth, and an order block gives us a precise target, all at the exact same price coordinate, we have built an A+ setup. Finding the zone is only half the job. The next step is execution. Many traders use a direct entry, placing a buy order the exact second the price touches the block to get the best possible profit margin. But if the market momentum is heavy, the price will crash straight through your zone. We use a confirmation entry instead. We wait for the price to hit the zone and form a distinct, complete bullish rejection candle. We only trigger the buy order after the candle's body fully closes. Waiting for the candle to close means you enter the trade slightly higher, which slightly reduces your overall profit margin. But letting the market actually prove its intent before you risk your money drastically protects your capital. This exact logic applies in reverse for a short trade. We identify a downward break of structure, wait for the price to pull back up into our golden zone, aligning with an order block, and verify a bearish confirmation candle. Before we execute, pause the video and look at these three dashed lines. Based on the structure, where exactly would you place your stop loss? The most common mistake is placing it perfectly tight against the top edge of the order block. In live markets, a sudden, sharp wick will frequently spike just past the structure level, trigger your stop loss, and then drop straight down to your profit target without you. To survive this, we use the buffer rule. We intentionally leave empty space above the structural level. This buffer absorbs those normal, quick liquidity grabs without knocking you out of the trade. Finding an A+ setup means nothing if a tight stop loss forces you out early. You have to account for market volatility. Executing this strategy effectively comes down to extreme patience. You have to wait for the structures to perfectly align, wait for the confirmation candle to physically close, and consistently apply your buffer space. Here is the complete rule set. First, identify a clear break of structure. Second, confirm a pullback into the golden zone. Third, verify an overlapping smart money block. Fourth, wait for the confirmation candle to fully close. And fifth, set your stop loss with adequate buffer space. Sticking to these 5 specific rules strips away the guesswork. It forces you to ignore mediocre setups and ensures you only risk your money when the market provides a highly accurate, calculated opportunity.